The Employees Provident Fund is one of the most popular investment options in India. In this, both the employer as well as employee contribute 12% of the employee's basic salary to the fund to create a corpus for the future. Launched in 1952, the goal of the scheme was to provide millions of employees with the better social security and secure future in exchange of hard work, effort and service that they offer to various organizations. EPF in India is regulated under Employees Provident Fund Organization and it has been regarded as a compulsory contribution fund. The USP of EPF, apart from the safety and high returns, is that it has exempt tax status. While that basically means that it is exempted from tax at the time of maturity. Further, the contributions you make towards your EPF account is also exempted. And lastly, the interest you earn on that is also exempted from tax. However, did you know that there are certain instances where your EPF contribution can also be taxed? Well, yes, that is right. For instance, the employers as well as the employees' contribution towards the EPF account can be taxable if it exceeds certain limit in one financial year. So in this video, let's learn more about the tax on Provident Fund. The Union Budget 2021 introduced taxability on the interest accrued on the Employees Provident Fund account contribution. So starting this fiscal year, the government has decided to split the existing Provident Fund accounts into two separate accounts in order to operationalize the new tax on PF income. While one account will capture the non-taxable portion of the employee's EPF contribution, the other will contain the information about the taxable components as per the Central Board of Direct Taxes. However, this does not at all mean that you can actually have two or you can open two separate accounts. Your EPF UAN, which is Universal Account Number, will remain the same. At present, the annual Provident Fund statement reflects your contribution with interest accrued. Besides that, they also reflect the employee's contribution and the interest accrued along with the amount earmarked for employees' pension scheme. Now, under the employee's contribution, they would possibly add two more columns, which will be regarding the excess contribution and the interest earned on this amount that will be taxed. Now, as per the new rules, the interest income on your annual EPF contribution over rupees 2.5 lakh will be taxed. Also, let me tell you that in case there is no employer contribution towards EPF account, then the threshold will be rupees 5 lakh in a year. Now, in order to better understand what the new rules are and how they will make an impact on taxpayer, let's now understand what are the key updates. Starting with, let's now understand what does two separate EPF accounts actually mean. So, as per the Central Board of Direct Taxes notification, to calculate the taxable interest under the Sub-Rule 1, separate accounts within the Provident Fund account will have to be maintained during the 2021-22 fiscal and all the subsequent previous years for taxable contribution as well as non-taxable contribution made by the person. Well, what this essentially means is that all the non-taxable contribution account will constitute the closing balance of PF account till March 31st, 2021 along with any contribution that is made by an individual in the current fiscal and in the later year within the threshold of rupees 2.5 lakh or rupees 5 lakh depending on the employer's contribution as well. Now, if the amount you have contributed is over rupees 2.5 lakh in one financial year and the interest you earn on that excess amount as well will be taxed as per the slab rate applicable to you. If you have made any additional voluntary contribution during the year, that will be taken into account as well. Rules on the implementation, however, has not been yet framed. Now, it has been said that this step by the central government is an attempt to rationalize the tax exemption available to high-income employees. Coming to the next question, when will this rule actually come into effect then? Well, the bifurcation of EPF or Employee Provident Fund accounts has to be maintained from the ongoing financial year itself. However, the contribution deposited in the taxable account in the EPF above the set limit, which will be taxed, will be applicable from April 1st, 2022. To clarify the amendment introduced in the Budget 2021, CBDT issued a notification showing the entire calculation of taxable interest relating to the contribution to the Provident Fund or recognized Provident Fund. So moving on, let's now understand how does the entire calculation of non-taxable contribution as well as the calculation of taxable contribution actually works. So the first one, which is non-taxable contribution. So any contribution which is made by the person towards his or her account up to rupees 2.5 lakh, in case there is employer's contribution involved as well, for each financial year 2021-22, then there is no tax levied at all. And in case only employees is contributing towards his or her EPF account, then up to rupees 5 lakh is not at all taxed. Also remember that the interest accrued on the closing balance as of 31st March 2021, as well as the interest accrued on the non-taxable contribution for each financial year will also be taxed. Now, coming to the next one, which is calculation of taxable contribution. So under this, any contribution which is made by the person in the account for each financial year starting from financial year 2021-22 is taxable. That is above, if you have contributed above rupees 2.5 lakh or rupees 5 lakh threshold, as ever the case might be. Here also you need to remember that the interest accrued on the taxable contribution from each of the financial years starting from financial year 2021-22 might be taxed. So let's understand this, what it actually means with a simple example. Let's say Mr. X has a total balance of rupees 5.5 lakh including the interest as of March 31st, 2021. Let's assume that he works with a private company and he has contributed a sum of rupees 3.5 lakh, which is the total contribution towards his PF account in financial year 2021-22. Assuming that the rate of interest he has earned is 8.5%, let's understand with the table now how much of income or the contribution he has made towards his PF, how much of that is taxable and how much of it is not taxable. So like I mentioned, Mr. X has contributed or has accumulated a sum of rupees 5.5 lakh, which includes the interest as of closing balance, which is as of 31st March 2021, including the interest accrued. Now, as we saw in the example, that person X has contributed a sum of rupees 3.5 lakh towards his PF account. Now, in that, as per the new rule, up to rupees 2.5 lakh is not at all taxed. However, the excess amount, that is rupees 1 lakh, will be taxable. Also, another point you need to remember is that as per the new rule, the interest that you earn out of the contributions you have made, that as well is taxed. So here in this example, the interest accrued for financial year 2021-22, here Mr. X has earned or accumulated rupees 21,250 as interest for rupees 2.5 lakh contribution towards his PF account. While on the other hand, the excess amount, which is rupees 1 lakh, on that the interest he has earned is rupees 8,500. Now, this alone, for that excess amount of rupees 5 lakh, the interest he has earned is 8,500, that will be taxed. So, in total, which is 8,21,250, that is not taxed, which is well within the limit which is set by the government. While on the other hand, the excess amount of rupees 1 lakh plus the interest, which is 8,500, will be completely taxed. Now coming to the last question, how will it affect the high income groups? Well, as per the government estimation, nearly 1,23,000 high income earners in India are making more than rupees 50 lakh every year in tax-free interest on an average from the Provident Fund. Moreover, these high net worth individuals make up for about 0.27% of the total 4.5 crore EPF account holders in the country. So the main purpose of this new rule is to prevent employers with a high income group from misusing the government welfare schemes and making the income tax fair for everyone. Now this will basically prevent the high income individuals from collecting tax-free amounts in the form of guaranteed return. So this was all about the new rule by the government, wherein from 1st April 2022, your EPF account will be bifurcated into two, which is taxable and non-taxable. Also, if you are someone who's more interested into knowing how you can invest in schemes like EPF, PPF or any other government-backed schemes, then hurry up and download our Financial Freedom app, wherein we teach you A to Z details and give you details about these schemes and many other things as well. Also, before going, do not forget to hit on the like button, subscribe to the channel and hit on the bell icon to get notified for our next video. Thank you for watching IndianMoney.com. Get wise, break free.